we cannot have any doubts that the crisis has had, please come in, sorry, has had an impact on banks' reputation. We have to remember we were never loved, okay? I always use this quote by Napoleon, saying that money has no motherland, financiers are without patriotism and without mercy, and without decency, sorry, their sole object is gain. Probably it's because some of the predecessors of Frederick didn't want to finance another war, or probably they were asking for the good reasons to pay the last war. Having said that, there has always been tension around the banking industry as such from immemorial time. But it's true that the crisis, and in particular this long crisis, has impacted very heavily on us. You know the story of credibility, trust. Well, you gain it at the speed that the palm tree grows, and you lose it at the speed that the coconut falls from the palm tree. And let's be sincere, there are lots of coconuts that have fallen during this crisis. Of course, not all banks are the same, or not all bank employees are the same. There were good and bad behaviors during this crisis. But we also need to recognize that denial is corrosive for trust. So as an industry, we need to accept the collective responsibility, assume the damage, and move forward, which is what is needed. Here we are going to debate about carrot or sticks, conduct in the banking sector. I'm accompanied by people that can help us to elaborate on this subject. We have David Wright, Secretary General of IOSCO. I'm not going to introduce David or any of the speakers. You have the CVs, and hopefully you have read them as I did. We have also Alison Cottrell, CEO of the UK Banking Standards Board, and Nicolet Jager, board member of the Foundation for Banking Ethics Enforcement. My idea is that I will give each of them 5-8 minutes for their introductory remarks, and then we will open the floor for questions and for further dialogue. I would like to see, your participation on this. So let me go straight forward. We don't have a lot of time. So David, please.
Thank you very much, Jose Maria and Chairman Wim. Thank you very much for inviting me here. And I think this subject is absolutely the right subject to be discussing. I've been talking about it, I think, for some time, and I do actually think it's a systemic issue. And I say that because the history of this crisis shows that a certain number of institutions, I'm not going to mention them by name, but the obvious ones that fail, right at the heart of those failures, it seems to me, were the overpowering, bullying CEO who didn't listen to his weak boards and with poor risk management and so forth. There's an eerie, I've always said this, there's an eerie correlation of those firms that failed, the big ones, and the way they conducted their business and in the end collapsed or were bailed out. And all of this is very serious, as we know. The FSB recently quoted an economist's estimate of the cost of this crisis, highest I've ever seen, 25% loss of global GDP against trend. So if we have financial institutions, not just banks, being managed by incompetent people with poor risk management and poor culture, you're heading for trouble, no matter who it is. And I suspect that all those banks and big financial institutions that have survived, did survive, were the ones that had much better management and culture at the heart of their institutions. So this really matters. And I think, and I've always said, it's systemic. We have a situation where trust in the financial industry is at pretty well an all-time low. Most people and surveys suggest that the financial industry is just about at the bottom of the pile, worse than state agents or whatever. Again, this is serious because the public won't invest in financial institutions. They'll buy real assets, they'll buy property, they buy art, but they won't invest. So actually at the heart of this is a much more serious problem about the allocation of resources in society and creating what I think Professor Smallborough was talking about, which is creating balance and trust in financial institutions and in society as a whole. And if these matters are not reformed, and if we don't make progress, then I think these societal balance questions will come up. And I remember about 4 or 5 years ago, I gave a talk to a big bank board, and I said, you know, the top people in financial institutions, this was in London, are paid 80 times a sister on a busy ward in a London hospital, 80 times, and this woman or person is looking after 300 or 400 very sick people. And society, in my view, unless it sees better and more responsible behavior, those sorts of issues are going to come back. And some recent political trends suggest that indeed these questions might be being asked more frequently. So what are the elements of this reform process? As I say, are so important. The first is, of course, corporate governance reform, and that, of course, means effective boards. It means competent people, and it does mean, in my view, a role for regulators to ensure, particularly on the largest institutions and those who, SIFIs, so-called systemic institutions, that they are being run by competent people. Now, a lot of people shy away from this. The Americans don't like it. But I think the costs of failure here are so high that I do think there's a public responsibility to vet appointments for such institution. The second thing is that I've heard an awful lot over the last 15 or 20 years about informal codes of corporate governance. I keep hearing it. I'm not entirely convinced. I think some matters of corporate governance should be enshrined in law. I think there has to be local variability. In Europe, for example, the subsidiarity principles should apply. But I'm not sure this sort of vague code stuff is really very effective. The second element of the regulatory response is, I think, being driven by some very useful work that the United Kingdom has done, which is called the Fair and Effective Markets Review. It came out in June. I think it was a political initiative, quite clearly, to deal with what one regulator has called the Wild West in the wholesale markets. So what are the elements of this? The elements are, firstly, to responsibilize, make senior managers responsible far more for bad conduct, fraud, etc. And Alison, I no doubt, will talk much more effectively than I can about that. But I do think that this is a very important initiative, and I think and hope that this can be replicated around the world. The second is to improve wholesale market conduct standards. IOSCO has been asked to try and take that forward. And this will be very difficult, in particular because I don't detect a great deal of enthusiasm across the other side of the Atlantic in the United States. The third element of this is, I think, a reopening of this debate about how much pay should be fixed and how much should be variable. But these issues now are right at the heart of the global agenda, and we are in planning to start stock taking and seeing on our side in IOSCO where the holes are and where there are regulatory gaps that need to be improved. As I say, I think it's going to be a difficult exercise, but we're on the job. The third element I want to just briefly touch on is we always talk about incentives, incentives for good behavior. But there's another element to this, which is disincentives for bad behavior. And I think if we're honest in this room, we have to say that over the last years, the sanctions regimes for bad behavior, and I'm not just talking about banks, but in general, have been far too lax. It's been far too difficult to take difficult but necessary deterrent sanctions, and I think their levels of fines have sometimes been derisory. They have clearly not deterred the worst forms of behavior, whether it's LIBOR, whether it's Forex, you know all about that, or whether it's mis-selling. There are just far too many scandals. And I think when I read certain reports of ombudsmen, the range of complaints is so wide that there's something wrong here in the, I don't say the state of Denmark, but in the state of financial markets. So in my view, the disincentives, the fines, the sanctions, and indeed prison for the worst offences has simply got to be ramped up. And if we don't do that, I fear that we will slip back to old ways. I'm not ducking here the role of supervisors. I think the role of supervisors, they have to up their game. They have to look much more carefully at where the risks are, but at the same time have the power to sanction much more effectively. Last point. I want to puncture this balloon that sort of is floating around that somehow all this is difficult. Oh, we don't know. There's so many codes out there. We're lost. I heard a bit of that a couple of weeks ago in London when we were talking about conduct standards and behavior. I'm sorry, I think most of us in this room have an instinctive feeling of what is right and what is wrong. There are grey zones, of course. The law may not always be precise, of course. But those are the very few incidents. So my view is, let's not hide behind some clear areas where improvements have to be made. I mean, after all, in life, if you don't know, ask the regulator. Ask the regulator to define the safe harbors or indeed improve the law. But let's not hide behind the fact that we don't know what is right and wrong in most cases. Thank you.
Thank you. Thank you very much. If you want, Nicolet.
Yes, please. First of all, I'm very happy to be here and to share with you, to have the opportunity to share with you what we've been doing in the Netherlands for the last period of time. And it touches upon quite a few things actually that have been said so far. Let me take you through some of the major, most important points. Obviously, we have the financial crisis in the year of 2008 that we'd rather leave behind us and forget about altogether, but we're not able to do so. The first reaction to the financial crisis was very much a reaction of more regulation, focusing on capital requirements and stability, and not even so much on conduct and the importance of behavior and the culture within the financial industry. Whereas in the Netherlands in 2009 already, discussions were started, which ultimately led to the introduction of the banker's oath, or the oath in 2012. And that was an oath that was introduced for policymakers only. Policymakers being people in the board members and other people who had an effect on the risk position of the financial institution. Obviously, it was very important to also focus on the customer's values, the culture, etc., to restore trust. And we have a vitally important sector in economy and in society, so we really need to be aware of that. We have, Dutch regulators also started to have a shift where, and David already mentioned that, people need to be knowledgeable and need to be capable of performing their job. But what is more important than only knowledge and experience, also to be suitable, which focuses more on ethics and being trustworthy. Isn't it more and more dangerous to have somebody who's very knowledgeable and very capable of performing his job, but not being suitable? So I'm very happy that the Dutch regulators actually made that switch to screening board members, etc., the policymakers on not only their knowledge and experience, but also on being suitable. Another example from the DNB, the Dutch Central Bank, is an assessment among 30 banks, insurance companies, and pension funds to assess the way board members were open and challenging each other. And they had a few psychologists performing these assessments and these discussions. And at first, board members on an individual basis, but also together as a group, they weren't very much charmed by the idea of being challenged. But it opened up, and it really stimulated the awareness of having an open culture and being able to stand up and speak up when you don't agree with something. And that's a start to put the wheels in motion. I already said that the oath was introduced in 2012 for policymakers, but that's not enough. And as you already said, David, you said, I don't like the fuzzy stuff and all that. And exactly that is the reason why the Netherlands realized we needed to take it a step further. Broaden the scope of the oath to all the people in the banking industry, which is about 90,000 people. This was realized beginning of April this year. And that's not the most important thing. Another step that we took was a very important step, in my opinion, and that is the addition of disciplinary sanctions to people who take the oath. So that's, first of all, the first oath where people, which created awareness among the people that took the oath, but the general public wasn't very much aware of what was going on, and this was a step taken by the industry itself. So changing from self-regulation with the industry to a legal basis in the Dutch Supervision Act, that was a big step. In April this year, as I said, we established the foundation for banking enforcement, for banking ethics enforcement, and also the oath that all the 90,000 banking employees need to take is for the period between April this year and April next year. So sanctions can be absolutely serious because the sanctions can, for instance, add up to a temporary occupational suspension for up to 3 years. Now that's serious. So it's a good addition, I think, to things that can be based on civil law to hold somebody liable, or labor law, where you can just simply fire somebody. But if that somebody with not being suitable goes up to another bank and says, I'm applying for this and that job, he can do the same thing all over again. So having that temporary suspension for up to 3 years from the occupation within the banking industry is a very strong sanction, and I think that's very good. We also are working on, and that's something that we're discussing with the privacy board at the moment. We're establishing a register where banks will have access to, and for instance, when somebody applies for a job, you can, certain people within the bank can have a look at the register and see exactly what sanctions have been published. So that's a very strong addition to the sanctions itself. I think all that together brings us at a point where we really have made some steps, some substantial steps to focus on the importance of culture, behavior, conduct. And I'm very happy, and to get back to our carrots or sticks, I think it should be both. I think it should be both carrots because it has to come from within. And if the morale of people, if the people are not suitable from their own personal beliefs, you'll have regulations all you want, but that doesn't do it then. So you need some sticks. And that's what we've done to create the foundation of banking enforcement, to create the sanctions that I just discussed. Anybody can file a complaint, any individual, but also banks. And that's an important thing to focus on, because banks have an obligation here as well. If they don't file the complaint when there's a disciplinary action within the bank based on, for instance, labor law, there's something that is responsible for the bank, responsibility for the banks as well. I think not only the oath, but in combination with the disciplinary sanction, it shows the commitment not only from the banking industry, but also from regulators, also from the government, to really get these wheels in motion and take a step further.
Thank you very much. I think that we have the first intervention was basically about sanctions, a big stick. I think that the second one was both of them. Alison, where do you stand?
Well, let me make some, just a few comments on conduct, on culture, and then to share some of the experience we've had from a UK perspective with the new Banking Standards Board, and it's fascinating listening to the different experiences and things, because there's a lot that we can learn from each other, because as we all know, conduct and culture are, yes, they're national issues, but they're local issues, and in a global sector, they are international issues. So I'm very grateful to the EBF for actually putting the focus on these issues today. Interestingly, given the title of this session about conduct, because thinking about it in the Banking Standards Board, which is a new body, we've only really been up and running for just over 4 months, we actually shy away from the word conduct. We don't use it that much, because when we use it, it triggers a conversation which can be quite narrow, because it becomes about compliance with regulation and managing conduct and managing the cost of conduct as a cost to the firm. Now, this isn't to say, of course, that regulation isn't important. It is crucial, and David has set out part of that. And compliance is crucial. You need to have effective proportionate regulation, effective active compliance. But regulation, as we've heard, is not the answer to every question. And regulation, we all know it cannot turn a bad manager or a bad role model into a good manager or a good role model. It would be a sad world in which anything that was not explicitly allowed or explicitly forbidden was deemed, okay, if it's not forbidden, it's okay. So there are other aspects that need to be brought into this. And we need to think, regulation cannot mandate integrity, and we cannot delegate responsibility for how we treat customers to the regulator. That responsibility has to stay with the firm, which brings us back to the point that we, of course, started this event with, about trust. And again, we started when we set up the Banking Standards Board to talk a lot about trust, and now we talk more about trustworthiness. Because again, when we talk about trust, it implies we need to persuade people to trust us. But it's actually about how can banks demonstrate they are trustworthy, which is then given by the customer to the bank, which takes us into the space, as we just heard, about both behavior and competence. Trust is a tricky thing to define. Lots of people can do it much, much better than I can. But it has to involve, surely, competence, honesty, reliability, all of these factors. So it's both the competence and the behavior. This is less about compliance with regulation. The regulation can certainly help encourage the right behaviors, the right competence. But it's about how a firm, any firm, a bank, any organisation would behave if the regulator didn't exist. And I would argue, given some of the issues that we're covering this afternoon, in a fast-moving sector, which has lots of disruptive potential, lots of changes in technology, having that basis of trust is even more important as we move forward. So we talk a lot about trustworthiness at the Banking Standards Board, and of course that brings us into culture. And culture, like trust, if anything, is even harder to sort of get our arms around sometimes, to define it and to measure it. It covers a range of issues, a range of things. It's both processes, it's about how those processes are carried out, it's about peer groups, it's about norms, it's about incentives, it's about lots of things. But the crucial fact is that an organization cannot choose whether or not to have a culture. We all know that. If a firm is any bigger than one team, it's probably got several cultures. The question and the choice for managers is, do they choose the sort of culture they want, and do they actively try to manage it? And that is really difficult, and it is much more difficult, as everyone in the room who has done this will know, than simply focusing on least cost compliance. Because managing culture, you never ever stop. You have to keep moving with it. This is not, as David has said, this is not unique to banking, and it's not a problem that's unique to the 21st century. This is really, banking has a lot of special characteristics, is a fundamentally important sector for the economy and society. But while it's special in lots of ways, human nature is not one of those unique characteristics. So there are things, again, that banking can learn from other sectors and from people coming into the sector from elsewhere.